Hi there, everyone. It's David from ALP Valuation Services. I wanted to create another Lunch and Learn video. Today, we're going to be talking about evaluating goodwill in a small business and why it's important to understand how we do this, especially if you or a client that you have wants to borrow money in order to do a business acquisition and maybe wants to borrow against the value of the goodwill. So here's the scenario. So someone wants to acquire a small business. And today, the Canada Small Business Finance Act program allows for up to $150,000 of financing for what are referred to as intangibles. So, what are intangibles? Well, it can be something like the goodwill in the business. So, this is basically value derived from the fact that the company is well known, has a client list, known trademark, people want to do business with the company. Also, things like franchise fees would fall into the intangible category as well. And so, one of the questions that we often get is people will say, well, are you certified business valuators then? Are you CBVs? Aren't those the people that evaluate small businesses? So I'd like to talk a little bit about the difference between what we do at ALP versus what a CBV would do. And then I'm going to talk to you about how we work with CBVs quite often, actually, when they're doing their work. So here's the big difference. For what we do, a most probable selling price evaluation, we are analyzing what we call Main Street businesses. So these are typically businesses with EBITDA earnings under $800,000 a year. Most of the files that we work on are companies that have sales into, just a couple $1 million. So these are real small businesses. The methodologies that we use are based on the International Business Broker Association standards that have an emphasis on market data. So I want to compare a dry cleaning shop with other dry cleaning shops of similar size and similar profitability that have already sold. And if I'm looking at a septic pumping company, I want to compare that with other septic pumping companies. The risk profile or the earnings requirement from a cash flow in a small business is determined by the risks that buyers see in that particular kind of business in that industry, given all of the different forces that work against that industry. And so the amount of rate of return or the requirements from buyers varies from industry to industry. So unlike, for example, homes, there's a certain market for three-bedroom homes in a given city. In the world of businesses, the same competitive market forces apply by industry across the country and into the United States as well. And so we want to do comparison by industry. It doesn't really matter where the business is. It's what kind of business is it and what factors give it, positives or negatives as seen in the eyes of buyers. And we want to look at this from the point of view of the people who are going to potentially be acquiring these businesses. The other big difference is that we consider the normal sale conditions or terms under which small businesses are sold, which often includes some degree of seller financing. And this varies, as I'm going to show you in a moment here, with what happens under a certified business valuators analysis of a business. So typically, CBVs are looking at larger businesses. In fact, most CBVs would say that a small business might be one with 10 million in revenue, for example. And certainly looking at businesses that have earnings far above what we are typically looking at in our small business space. The methodologies that CBVs are using are based on return requirements from investors. They will use methodologies such as doing a buildup of a capitalization rate, looking at different factors as it applies to each particular business. And typically, these evaluations, start at over $10,000. They're typically five-figure prices, and they look at the fair market value of a business in terms of a cash transaction, which is not typical for small Main Street businesses. In most Main Street businesses, there is some degree of seller financing in play for the most part. Now, so how do we play together with the CBVs? We are often engaged by CBVs to do certified machinery and equipment appraisals so that they can get part of the information they need when they're doing their calculations for their work with clients. And these are typically pretty large projects where we go out and appraise sometimes hundreds of capital items across multiple locations for some of these businesses, which, as you might imagine, is very different from the situation that we would normally see if we were helping someone to get financing, for example, for a dry cleaning shop or an auto repair business or something like that. So, how do we determine the goodwill? Well, basically, we use two different kinds of reports. We use our most probable selling price evaluation to determine a value for the entire business as a going concern. And then we do a certified machinery and equipment appraisal to verify the value of the fixed assets. And then the one other component to this, of course, is the operating capital. You can see there on your screen in this image, we look at what the business is made up of. So there's the fixed assets, the operating capital, and the goodwill. And then next to it, you can see how buyers finance these different components of what they're buying. So what we do is we look at the components of purchase price, and then we modify this for the anticipated transaction format. So, for example, if the purchase at hand is contemplating a share sale, then we will look at what the normal required operating capital is in that business to determine that operating capital component of the business components. We then verify the fixed asset value through the certified machinery and equipment appraisal, and basically the difference is the goodwill. And so if it is a more simple asset sale that is contemplated, let's say a small retail store where receivables, payables are not being transferred, cash accounts are not being transferred, but say inventory is, then we will adjust that in our model. And so we look at what is actually being transferred in the transaction. And so there could be share sales, there could be asset sales. And of course, as I said, we adjust this for whatever is actually being transferred in the transaction. What are the costs for the borrower to do all of this work? Because now we're talking about two different valuation projects. Well, the MPSP valuation on the small business, I mentioned earlier that CBV valuations often are in the five figures, starting at 10,000 and up based on the size and complexity of the project. Our evaluations are typically between $2,000 and $3,000 for most of our small business, what I like to call Main Street business clients. The CMEA valuations on the tangible assets, the price of this is driven entirely by the number of capital items present in the business. We treat capital items, so these would be pieces of equipment with original values of $2,500 or more. We treat them differently than we do the small items. We use different types of methodologies based on the material impact of the item to the business using this capital item definition. So for most small businesses, if I'm going to think about an auto repair business or, sort of a fast food restaurant or something like that, we're typically looking in the $2,000 to $3,000 range as well for the most part. And so if there is real estate involved, our evaluations do not include that. So then there would also be the requirement, of course, for a qualified real estate appraiser based on the type of property that it is to come and evaluate the real estate. For the MPSP evaluation, if there is real estate involved, we will want to have that appraiser's report because we need to know what, for example, the true fair market rent or income potential of the property is, because oftentimes we're looking at an organization where the business owns the property, and in order for us to evaluate the business in isolation from the property, we will have to adjust the income statement by using an imputed rent factor. And we're going to look for the real estate appraiser's report to show us what that reasonably should be. Them being the experts in what the rental rates are in a given market and that kind of thing. So for more information, we do have a special report called Small Business Values Demystified, How We Determine Value and Goodwill, that we'd be more than happy to send out to you. If you sign up for our email list and you are a lender, for example, then this is one of the reports that we send out to you on a regular basis. For everyone who joins the email list, we send out a copy of the Essentials of Machinery and Equipment Appraisal, which kind of gives the basics on our certified machinery and equipment appraisals. You get notified by being on the email list. We send out one email every month. That's it, just to let you know about new videos like the one you've just seen here. And please go visit our website and explore our frequently asked question library. There's a whole tab on the website about business valuations where there's a walkthrough of what the MPSP process and report looks like, So you can actually take a look and see what you'll be getting if you order such a report. And again, that's over at BusinessAndAssetValues.com. And we encourage you to call us or email us with your questions. Always looking to meet new people and to figure out how we might be able to help you and your clients with your appraisal and evaluation needs. Thank you very much.